today. Probably touch on an issue with regards to dividends, yield and growth, and it's an area we've touched on in the past, but probably want to show some live examples. Now, the example we've got here is comparing three different businesses, and we've got this off the Roger Montgomery website, his blog post. So well worth reading Roger's information, and so yeah, please Google him and check out the stuff he writes about. It's all very good common sense stuff, but this is the type of things that we're forever talking to our clients about. So what we've got here, it's instead of focusing on the yield, the dividends only, and these are the calls that I often get where people say, interest rates are so low, we really need to get a focus on dividends and focus on getting a good income. And I keep telling people that we've got to be a little bit not focusing on dividends and also focusing on growth. And here's some great examples of that. So we've got three companies, two telecommunication companies, M2 and Telstra that we know of, and very much a growth company, CSL, that works in the pharmaceutical area. Now, we've got $100,000 to invest, and looking at the figures here, in 2005, we've got M2 with a dividend of 3.9, nearly 6% through Telstra, and just over 5% for CSL. Now, based on that information, most investors will probably say, well, I'll take the higher dividend. That's a considerably higher dividend than M2. That's $2,000 extra, and well more than CSL. So when you look at the raw facts and just focus on the dividend, you're often missing out on some potential growth. So if we wind the clock forward 10 years, we can see what's happened to these businesses, and that focusing on dividend alone means that you're potentially missing out on substantial growth. So $100,000 invested into Telstra 10 years later is $117,000. $100,000 to M2 is $3 million. And $100,000 to CSL is now $1 million as well. More importantly, when we're looking at the dividends, and this is the very impressive part for both CSL and M2, less than $4,000 in 2005, 10 years later, it's a $100,000 income. And again, substantial growth there, whereas Telstra has had some improvement, but it's been pretty marginal, and still Telstra has the best dividend, the highest yield, but it's still not the company you would invest into. Now, the reasons for this issue that over the years Telstra has paid out all their profit as a dividend, and in some years have actually borrowed money to continue paying the same dividend as they have done in the past. Whereas I know CSL, and you can see here it's a very pitiful 1.8%, I know that they only pay out 30 to 40% of the profit they make. So that means they're retaining up to 60 cents in every dollar of profit to reinvest back into the business to create new vaccines, or like they did recently, buy another business. M2 Telecommunications have done this as well, and they've also used debt extremely well when they've been acquiring businesses and then growing the business, growing the revenues and therefore profits. So hope you enjoyed this. Please don't just solely focus on dividends, because dividends mean you can potentially miss out on substantial growth. Thanks for listening.